The stock markets may not recover to their all-time highs for another decade, warns our next guest. And now is not the time to be a buy and hold investor. So what should you do instead? Joining us now is veteran trader Jason Shapiro, principal of JS Trading, who has been featured in Jack Schwager's new book, Unknown Market Wizards. Jason has been a trader for decades, having worked at HSBC, George Weiss Associates, Perpeck Futures Management, and RI Ventures. He currently also runs the Crowded Market Report. His claim to trading fame: be a contrarian and do the exact opposite of what the herd is telling you to do. Jason, it's an honor to have you here on Kitco. Welcome to the show.
Thanks for having me.
Jason, you and I spoke offline not too long ago, and you told me about your long-term outlook for the markets. And it's not great for a stock market trader. Give us your outlook here. Set us up.
I mean, I think that, and this is just my personal opinion, and obviously just like anybody else, I could be completely wrong, but I don't think that long-term returns for the stock market here are very good. I build my stuff mostly around participation data. And when I think about the amount of money and the type of money that had piled into the stock market over the last couple of years, this is not money that historically makes good returns. And we had records amount of it come in since COVID. So I don't think that those investors are going to make very good long-term returns over time. So my feeling is that long-term, meaning if you go 5, 10, 15 years, I don't really think that there's going to be any kind of positive return in the stock market. Now, that's not to say that there's not opportunities in that time period. I just think buy and hold for the next 10, 15 years is not really going to be very good.
10, 15 years. So if not for the stock markets, then where do people go?
You know, you have to be able to make money in the moves rather than buying and holding, I think is really the situation. You know, I think that for me, the best analog or whatever you want to call it for where we're going is, you know, you can look at what the Nikkei's done. You know, the Nikkei topped out 32.5 years ago, right? And I think it's down about 28% from the highs from 32.5 years ago. Now, in those 32.5 years, I was actually looking at it this weekend, there's something like 40 moves where the market moved 20% or more. Sometimes it moves 60, 70% over time period. So there's plenty of money to be made during that. I just don't think that buy and hold is the way to do it.
Okay. So just to clarify here, you're comparing the U.S. markets to the Nikkei in the early 90s when it bottomed and didn't recover for several decades. Is that what's going to happen with the U.S., you think?
I think that, yeah, I am giving the Nikkei as an example of what can happen with markets where they really don't go. I mean, you could go back to the U.S. I mean, the U.S. topped in 1968 and didn't bottom until 1982 and really didn't get back to highs until, you know, 1986. So, you know, there's a lot of time periods where markets do this type of thing. And I think that we are set up for one right now. Yes.
I'll go back to your macro thesis here. I'm just curious as to what you're setting this up or basing this on. Are you concerned about interest rates rising? Are you concerned about the end of zero interest rates? Or are you concerned about slow growth, a depression, recession? What's going to hold us back from new all-time highs for a while now, Jason?
I'm not even necessarily saying we can't get back to new all-time highs, but
yeah.
What concerns me is not so much the macroeconomic issues. I don't have any ability to forecast macroeconomics over any kind of period, much less 20 years. I'll say this, the Nikkei from 1989 till now, again, is down 28%. The GDP in Japan has doubled in that time period, okay? Interest rates in that time period went from 8% to 0%. So interest rates have done nothing but come down. GDP has doubled. And the stock market's down 28% in 32 years. So I don't really think that's the issue. Again, to me, the issue is, are the investors that have piled into the market typical of investors who make money over time? And my answer to that is absolutely not, right? You had a lot of money that I don't call dumb money because I don't like to call people dumb, but you had a lot of money that doesn't really know very much about markets and about history of markets and about how markets work, piled into the market, who believe that the only function of how much money you make in the market is how much you put in. And I think the time has told us that that is definitely not true.
Do you foresee volatility picking up then, if you think this is going to be a trader's market for the next while?
I think that this is a trader's market for a long time, yes.
Okay, so how do you trade volatility? Can you give us a bit of a primer on some of your strategies here?
I mean, the way that I personally trade is I am a fader of mass participation. So I look at sort of how many participants are super long the market, at which time I'm looking to get short. I look at people when people are super short the market, at which time I'm trying to get long. So for example, back in June, I was buying because people were super short and super bearish, and you saw all kinds of sentiment indicators setting records. And to me, that's a good risk reward time to be buying. And when that flips and goes the other way, then you go the other way. And what I personally think is going to happen is people are going to start to buy into the mantra that the Fed is done raising rates. And therefore they will start thinking that it's okay once again to enter the market. We've started to get that, but we haven't gotten that full force. My feeling is that the day that the Fed does their last rate rise will be the day that the market will then top again, and you'll be able to sell. You know, that's kind of how markets work. You know, it will discount in the news first, and then once the news hits, you know, you sell it. So I think that that's where we're at right now in the market.
All right. You base a lot of your decisions on the crowdedness of a market. Would you say that sentiment right now is super crowded on the bearish or the bullish side?
I think it's come off. I mean, it was super crowded on the bearish side back in June.
Yeah.
And now that we've kind of had this rally and whatnot, that's clearly coming off. You know, I would argue that it's still to the bearish side. I would say most fundamental analysts still believe that the lows are not in, and that this is a bear market rally, and which is why I continue to be long. Once that has given up, once these people have decided the low is in, and this is not just a bear market rally, that this is a actual next leg of a bull move, that's when I'll be getting out and looking to go the other way.
Okay. You told me offline as well that some of your trades can be attributed to directional trading. Can you explain what that is?
So all of my trade are directional bets. I'm not doing like long short or anything like that. I'm either going long a market or I'm going short a market. So yes, all my trades are directional like that.
Can you explain exactly what that means, directional trading?
Well, I'm either making a bet that the market's going up, or I'm making a bet the market's going short. I'm not doing any kind of relative trading or,
I see,
you know, long short trading or anything like that. It's all just a bet on up or down.
Mm-hmm. Okay. Besides the equity markets, are there any other markets or asset classes that you particularly like or dislike right now that you would definitely take a bet on one direction over another? Like, let's say commodities, for example. We've seen a top in the commodities several months ago. Food, base metals, they've all come off from the tops. How do you feel about commodities?
So the commodities, again, a few months ago got way exaggerated. People got way bullish and they got way long, right? I'm not talking about price here. I'm just talking about participation. I don't know if you follow it, but The Economist had a cover story about the coming food shortage and had a picture of wheat on the cover about 2 months ago. And wheat's down something like 50% since that cover story came out, right? So a lot of that froth in positioning and that froth in bullishness has certainly come off of the commodity markets here, you know? Yeah. But it's not like they've gotten super short either. So I was kind of shorting those things up there, and now I'm out of those shorts and I'm just sitting and watching and waiting. If I do like a commodity market here, it would be the metals, platinum, gold, silver, which also I would say on a portfolio basis, if you are playing long stocks, I would think on a portfolio basis, long the metals would be a great hedge to that. Okay. I think they can both make money, but certainly I think it would be a great hedge as well. So that's kind of a good portfolio trade as well.
I think there was a running joke amongst traders that the Economist covers have historically been a good contrarian indicator. So I think that was just one point that illustrated that joke.
The wheat one was an all-timer. I mean, it literally came out pretty much the day that wheat topped, and you're talking about a 50% move in 8 weeks. You know, which is, I mean, think about if the stock market moved 50% in 8 weeks. Either way, right? People will be going crazy, right?
Right. I mean, it's a crazy market. Let's talk about gold and silver and in the metals. Yeah. So gold has been trading flat all year. It's slightly down. Are you seeing maybe a bottoming pattern here, or a consolidation? Is it due for a breakout either way?
You see the least amount of long gold participation right now as you've seen in 3 years. Okay. So again, that's really what I trade off of. So that's why I'm long. If you want me to make the fundamental argument, I can try, but again, if the Fed's going to stop raising rates, then theoretically, that's more bearish dollar, and also more bullish, precious metals. So I think it's a good risk reward place right here. Yeah.
Speaking of contrarian indicators, there's this thing that's circulating online that's called the Jim Cramer indicator. It's kind of a meme trending on social media. Basically, whatever Jim Cramer recommends in position, you take the opposite side. Is that you're nodding your head? I'll let you comment on that.
It's funny you talk about that because we do talk about that on my crowded market report. I have a Discord page where we all interact, and we have talked about the Jim Cramer thing for quite a while. And in fact, I don't really do individual stocks very much other than my retirement account, but I did buy Boeing stock. The day that Jim Cramer came out and said that he was selling Boeing stock.
Okay.
And I think Boeing's up 40% in 8 weeks since then. But the funny part about that is, it's funny that you mentioned that, because what we've been talking about on my Discord is how everybody now seems to be on top of this fact that Jim Cramer is a huge fade, right? It seems to be all anybody's talking about. It's all over Twitter. You've got this fade Jim Cramer on Twitter, and you've got all these kind of contrarian Jim Cramer things. It's almost time to start going with Jim Cramer, because so many people now want to go against him.
That's it.
So, contrarianism can be pretty funny like that, but it's funny. That seems to be a very popular subject nowadays. And in truth, I don't have anything personally against Jim Cramer.
No.
Other than, he does his job. He's got a job. He's an entertainer, I think that if you did go ahead and look at his long-term returns for his charitable trust, if he makes those available, I don't know. I'm sure they are underperforming the market by quite a bit, but which is why he doesn't talk about it. But
Speaking of memes and crowded trading, how do you feel about meme trading? The idea that people talk about some trending thing on social media, a meme, if you want to call it that, and they base a trade on it. We've seen the most prominent example of this last year during the GameStop squeeze, AMC squeeze. A bunch of people on Reddit started talking about it, and then it shot up. Hundreds of thousands of individual retail, unaffiliated to each other, retail traders started just to pile into one position, and it moved the markets tremendously. Is that something that you would consider not, following or advocating for? If you see a bunch of people talking about something on Reddit, would you get in?
No. Me personally, no. I don't do that. I have a process that I've built over 35 years of trading that I follow religiously.
All right.
I think one of the single most important, or probably the single most important thing with trading is discipline. I stick to my discipline. I don't do other things, right? Now, does that mean other people shouldn't do it? Go for it. Good luck. I thought the GameStop thing was one of the most enjoyable things to sit here and watch that I've seen in years. The fact that a bunch of these retail traders came out and smelled out where people were way too short and squeezed it up and got them to cover their shorts. And it was like, this famous hedge fund trader who was all Mr. Smarty, billionaire, genius guy. And he got ripped by these retail traders. I thought it was beautiful.
I think a lot of funds who took the opposite side got ripped. I mean,
that's what it is. That's what the market is, though, right? It doesn't matter. You think you're the smartest guy in the world and all that. You are vulnerable. That guy in particular was short so much GameStop, that there's no risk management. All it takes is one bad trade when you don't have risk management, and you can blow out. And that's what happened to him. He's out of business now. And who would have thought that a bunch of, 22-year-old retail traders would have blown out this, genius billionaire hedge fund manager? But you know what? You get too big for your britches, and that's what happens.
Yeah. When you look at any asset class, I'm just curious to see what your discipline approach is. Do you have a certain, I guess, buy-in or exit signal that you look for? For example, let's say the crypto Bitcoin's down 70%, 75% from its top. the crypto markets overall are down, more than that if you want to count the altcoins. Would you look at this space and say, look, it's gone down enough, it's oversold enough, it's time to get in? Or would you have some other indicators that may point to you that this is not done yet in terms of the correction in this space?
I personally do not use price as an indicator. I don't believe in, it's gone down enough that I'm going to buy, or it's gone up enough that I'm going to sell.
Okay.
I strictly look at participation. So in other words, people are too short, I'm going to buy. People are too long, I'm going to sell. I find that people are still too long Bitcoin for me to ever get as a buy. They were max long right at the top. Looking at the participation data, they were maximum long Bitcoin at the top. And they have taken some of that off, but nowhere near enough that I would ever get involved. Personally, I have a long-standing bid in Bitcoin at 3,500. We'll see if it gets filled, and we'll also see if I keep it if it does get filled. But and that's just sort of a game that I'm playing there. All
right, 3,500.
I'm not a big believer that Bitcoin or that the coins are going to have any kind of sustainable rally. They'll rally, I would guess, just like the stock market's rallying here. But as soon as that's over, which I'm guessing will be on Fed Day in September, I think that will all be over and Bitcoin will go right back down.
Interesting. And just closing up on the indicators that you look at, let's take stocks, for example. They're a little more liquid than most of the cryptos here. So indicators for the stock markets in terms of the participation, would you look at the options for how many people are long one direction or short one direction? Would you look at the futures? What would you look for?
I look at the options skew. Yeah. I look at the commitment to traders report a lot, which shows the direction, where people are positioned in the futures markets. Those are the two main data sources that I use. And the rest is all kind of a discretionary read on what I'm hearing and listening to people saying, To me, it's very hard to find someone who's right about the market a lot. And if you do find that person, I can tell you that it's very hard to get them to speak, right? But what it is very easy to find, as we go back to the Jim Cramer example, is a whole bunch of people who are wrong about the market all the time, and they're speaking all the time, right? What do they say? Those who know don't speak, and those who speak don't know, right? So I like to listen and read and listen to the TV and the people on TV. And when they build a consensus, when I can sit here and listen to, let's say, Bloomberg News all day, and you get 20 people on there and all 20 of them are saying the same exact thing, to me, that's building consensus, right? And so I read that consensus, plus I'm reading the options and the futures, and when all of that lines up together,
right,
that's when I'm looking to put on a trade. And then I'm waiting for sort of a market confirmation before I do it. And market confirmation to me means the market really needs, the tone of the market needs to change. So if it's going down, 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 and I'm listening to why people think it's going down, whatever it is, the Fed's raising rates or there's too much inflation, et cetera, and then you get that news to continue and the market stops going down on that news. That to me is telling me everybody has already played that trade, right? So I'm looking at the data, okay, they're already short. They're already short because of the inflation numbers. Here's an inflation number that comes out bad, the market doesn't go down anymore. Well, why doesn't it go down? Well, because all those people that want to make that trade have already done it. And that's how I approach trading. So,
at what point in your career did you realize that the market's not always right? If a lot of people are on one side of the trade, if a consensus has been built, it doesn't necessarily mean that the herd's going to be right. At what point did you realize this, Jason?
Did I realize that the consensus is not going to be right? Or
yeah, did you realize that the consensus view on any one position is not always right?
Not only is it not always right, it is the vast majority of the time wrong, okay? And how I realized that was I was part of the consensus for when I was a younger trader, right? You read the things and, oh, everyone's doing this, let's do this. And all I did was lose money. So it becomes very clear, trading gives you a very clear answer to whether what you're doing is right or wrong, as long as you have an open mind. If you want to argue, oh, the market's wrong and I'm right, okay, that's great, but you're losing money all the time, right? To me, if I'm losing money, then clearly something I'm doing is wrong. What is it? And it became very obvious to me that if most of the people lose money, then why not go opposite most of the people and make money?
There's this theory among some economists and academics that the markets have already priced in all available information. It's called the efficient market hypothesis, that, long term, you really can't generate any alpha because no one individual person has a lot more information than the entire market. So at any one point in time, the markets are already perfectly priced in. All available information are perfectly valued. How would you respond to that?
I think that I agree with the one side of it, okay? Which is that you have a lot of smart, well-educated people doing a lot of work on the fundamental side of the market, right? So how you're going to get an edge over that, right? I just don't know, okay? I don't know where you're getting an edge over that, right? The markets are a discounting mechanism. So you can do all the work you want and find out that, hey, Apple is a great company, right? But is that really giving you an edge? Because everybody already knows that, right? So I agree with that side of it. As for, do I agree that anybody can add any alpha? See, the argument I make is, while it's very hard to find people to really add alpha, it's actually very easy to find people that are getting a lot of negative alpha, right? Okay. And so all I'm trying to do is capture that, find the people that are adding negative alpha, let's call it for lack of a better word, and do the opposite of what they're doing. And therefore their negative alpha becomes my positive alpha. That's as simple as it is. I don't try to, people get caught up in they're trying to be smarter than the market. Yeah. I gave up on that a long time ago. Okay. But I do believe that there are a lot of people that are dumber than the market. And so therefore, if I can just fade them, I can make money.
I'm not gonna speak against the entire asset management industry here, but I do want to bring up this experiment that was done a while ago. They got a monkey to throw darts at a board, and the board was covered with stocks. And just for the viewers who don't know about this experiment, the monkey threw darts at this board, and whatever the dart landed on, whatever stock that the dart landed on, they would hold those stocks for the year. That portfolio of stocks, that basket, outperformed the majority of fund managers that they polled in that particular year. Jason, I'm not saying that all fund managers underperform the market. That's not true. You've got outperformers, of course, but generally speaking, the average fund manager, what is he doing wrong? Why is he not beating the market?
I think he is trying to be smart rather than trying to make money. These are people who, for the most part, went and got MBAs from top schools. The way they got into those MBAs from top schools is they were very good college students from very good colleges. And the way they got into being those very good colleges was they were very good high school students. They got positive response from the fact that if they work hard and they're smart, they're going to get rewarded, okay? They got rewarded by getting into a good college. They got rewarded by getting into a good MBA school. They got rewarded by getting a good job in the asset management industry, okay? And so that is how they are trained to think. But to me, that doesn't work in the market for the exact reason that you were talking about before, which is the efficient market hypothesis, right? You can be the smartest guy. You could actually be the single smartest person in the market. That's not going to get you anywhere because you have to be smarter than all of the people in the market in aggregate, and nobody is that smart, okay? So that's what they're focusing on, and I think they're focusing on the wrong thing. Investing at the end of the day, because the market is efficient and because the market is a discounting mechanism of the future, and because today's price already discounts everything that we know about the future, it can't be taken like that. It has to be taken like gambling, You have to be thinking, there's a book by Annie Duke, Thinking in Bets, I think it's called. You have to be thinking of it as a bet, right? Are the odds in your favor? And if so, put the bet on, but realize that just because the odds are in your favor doesn't mean that it always works. So now you have to manage your role as well. It's a combination, which is the risk management side, is a combination of those two things. If you're flipping a coin, heads or tails, and you're getting paid 60 cents every time it's heads, and you're paying 40 cents every time it's tails, that's where you want to be. It doesn't mean it's always going to come up heads. It means it's going to come up heads 50% of the time, and it's going to come up tails 40% of the time, right? But if you're getting 60-40, 60-40, you want to flip as many coins as you can in that situation. And over time, you're going to make money. To me, that's what investing and that's what trading and that's what all of this is all about. And I think these people underperform because they think it's about being smart.
Okay. I'm just curious as to what contrarianism, does it work for all markets, especially all market sizes? Say you have a relatively small market, relatively illiquid market, and you got a lot of people long on one position. Maybe they know something that other people don't because it's a relatively small market versus something like Apple. You've got a lot of, let's say the consensus is long, you've got a lot more calls and puts. You're short that. Would the size of the market determine whether or not you're short or long something? We're taking the contrarian side.
The only thing that will change for me, depending on size of the market, is if it's not as liquid, then I can't have as big a position. I do trade some of these a little bit more illiquid markets, but because of the amount of money I trade, I can't put a full position on there from a risk management point of view. But no, it doesn't change my idea of contrarianism. In fact, it tends to work even better in some of these small markets, because if everybody's caught long in something, and the thing starts to go the other way and they have to get out, the liquidity isn't there for them to get out. So the move ends up being exaggerated.
Hey, Jason, I just want to thank you again for coming on the show. I learned a lot today. So hope to speak to you again and talk more about the markets and trading. Thank you very much.
All right. Thanks for having me.
Thank you for watching Kitco News. I'm David Lin. Stay tuned for more and don't forget to subscribe to our YouTube channel.